Lesson 14.3 for accounting this chapter, it deals with promissory notes. You are going to learn how to record the acceptance of a note receivable, the collection of a notes receivable, and then what happens if a business dishonors a notes receivable. Cash is the primary medium of exchange for business transactions. Cash is used to purchase merchandise and to pay for salaries and other expenses. In turn, businesses receive cash when they sell their products or services and collect payment. The cash received can be used to purchase more merchandise and continue to pay salaries and other expenses. Sometimes the receipt of cash from sales does not occur at the same time and in amounts sufficient to pay for needs of purchases and expenses. When this occurs, a business must make arrangements with its vendors to delay payments or to borrow additional cash. Generally, when a bank or business lends money to another business, a loan agreement is made in writing. A written and signed promise to pay a sum of money at a specified time is called a promissory note. A person or a business to whom a liability is owed is called a creditor. A promissory note signed by a business and given to a creditor is entered in the business books as a notes payable. A promissory note that a business accepts from a customer is entered in the business's book as a notes receivable. Notes payable and notes receivable are frequently referred to simply as notes. The person or business that signs the note and thus promises to make payment is called the maker of the note. The person or business to whom the amount of the note is made payable is called the payee. The original amount of the note, sometimes referred to as the face amount, is called the principal. The percent of the principal that is due for the use of funds secured by the note is called the interest rate. The date on which the principal of the note is due to be repaid is called the maturity date. The length of time from the signing date to the maturity date, usually expressed as numbers of days, may be referred to as the time of the note or term. To be legally enforceable, the signing of the promissory note must be witnessed by a person who is not a party to the agreement. The witness must also sign the note. Let's take a look at an example of a promissory note. You have the number assigned to the note. They keep them in numerical order. The date the note was signed, the time of the note in days, and this will be used when you calculate the due date. The payee, which is the person or business to whom the amount of the note is payable. The principal, which is the original amount of the note. You also have an interest rate. It's the amount of money you have to pay to borrow the money. The maturity date, you take March 18th, you add the 90 days, and you come up with June 16th. The maker of the note and the witness. On occasion, a customer may not be able to pay an amount owed to a business by the due date and might request additional time. The business should require the customer to sign a promissory note. A note does not pay the amount the customer owes. However, the form of the asset is changed from accounts receivable to a notes receivable. Notes provide an advantage over oral promises, and accounts receivable or payable. The note is a written confirmation of the amount owed that provides a business with legal evidence of the debt should it be necessary to go to court and collect. When a customer signs a note, the principal amount is debited to an asset titled notes receivable. One asset, an accounts receivable, is replaced by another asset, a notes receivable. Like accounts receivable, notes receivable is an asset with a normal debit balance. So let's take a look at the transaction that deals with accepting a notes receivable from a customer. Remember, the customer has decided that they don't have the money to pay the bill right now, but they don't want to be written off. So instead, they're asking for a notes receivable for the amount. And then when the time comes, they're going to pay back the note plus the interest that goes along with it. March 18th accepted a 90-day 8% note from Skinner College for an extension of its time on the account. And you can see the dollar amount right there. What's going to happen is in our general ledger, our notes receivable is going to go up $2,578.35. for the amount of the note, the amount basically that they're borrowing from our business. Accounts receivable is going to go down by the same amount because basically you're transferring the amount from your accounts receivable into a notes receivable, because we are not going to receive that money for maybe 90 days or longer. The third account affected is Skinner College. We are going to reduce that account by the amount of the note because now we've changed the accounts receivable into a small loan for this college. So when we look at it, we can tell that Skinner College doesn't owe us anything on the books. Instead, it has been converted over to a notes receivable, which is like a small loan. To record this in our journal, we will take our information from our T accounts. We'll put the date as the 18th. Notes receivable is going to be debited. The source document is notes receivable number 6. The total amount of the notes receivable. Accounts receivable and Skinner College will be credited for the same amount. Time to figure out the interest on a promissory note. This was a promissory note that we used earlier. And what we're going to do is we're going to take a look at the amount of interest that's going to be due and the maturity value of the note. An amount paid for the use of money for a period of time is called interest. Bank and other lending institutions charge interest on money loaned to their customers. The interest rate is stated as a percentage. Right here, you can see this is a percent. It's also found down in your note right here. 8% means that 8 cents will be paid for each dollar borrowed for a full year. Okay, and you can see that we didn't borrow this for an entire year. The principal, $2,578.35, comes from right here. It's the principal of our note. The interest rate is also found on our note right here. The fraction of time. The time used in calculating interest is often stated as a fraction of 360 days. And that's how we come up with this fraction right here. It's 90 days divided by 360 because this note is not for an entire year. So we'll take the principal times the rate of interest times the fraction of the year, and you will come up with $51.57. So it is going to cost Skinner College $51.57 to borrow this money in a promissory note for 90 days. The amount that is due on the maturity date of a note is called the maturity value. Skinner College's 90-day note with principal of $2,578.35 and interest rate of 8% will have a maturity value of $2,629.92. So again, you're going to take the principal of the note plus the interest that has accrued, and you'll come up with your maturity value. Next, we're going to figure out the maturity date of the promissory note. We have to figure out what date this note is due. You will use a table that looks something like this. The term of the note, 90 days. Then you're going to figure out how many days are left in March. From March 18th through the 31st, there's 13 days left. At the end of March, you have 77 days remaining on your note. You take 90 minus 13 is 77. April has 30 days. So at the end of April, you will have 47 days left. 77 minus 30 is 47. May has 31 days. At the end of May, you have 16 days left. 47 minus 31 is 16. In June, there's more than 30 days. You only have 16 days left on your note. So the date that it is due, or your maturity date, is June 16th. Going on to collecting principal and interest on a notes receivable. When a note receivable reaches its maturity date, the maker of the note is expected to pay the maturity value to the payee. The interest earned on money loaned is called interest income. The interest earned on a note receivable is credited to a revenue account titled interest income. Interest income is investment revenue rather than revenue from normal operations. Therefore, interest income is listed on the chart of accounts under the classification titled Other Revenue. Again, it's another source of revenue. It's not one that a business really counts on. It just happens when we create some promissory notes. Remember, interest income is a source of revenue. Revenue has a normal credit balance, so you'll increase on the credit side, decrease on the debit side. Collecting principal and interest on a notes receivable. June 16, received cash for the maturity value of a notes receivable number 6, a 90-day 8% note. The principal was $2,578.35 plus interest $51.57 for a total of $2,629.92. Once you receive that, you give them a receipt. The accounts affected, cash is going up for the total amount. You are going to receive the principal plus the interest. Notes receivable is going down to cancel out the note. You received the entire amount, so therefore you're going to cancel out the note. And your interest income is going to go up. Remember, cash is for the total amount, notes receivable is for the principal, interest income is for the interest. Next, we'll take this information and place it in our journal. Since we are receiving cash, we will use a cash receipts journal. Fill out the date as the 16th, account title, notes receivable, we are going to credit. There's no special amount column called notes receivable, so we will place that in our general credit column. Interest income is also a credit. No special column for interest income, so that'll go as a general credit. Our debit amount for the total amount, our principal plus our interest, will go into the cash debit. Again, in your source document, you will put receipt 782. Next, we're going to go on to recording a dishonored note receivable. So you've worked with some customers. They could not pay their bill on time, so therefore they took out a notes receivable or a promissory note, promising that they're going to pay at a later date. And now in return, they decided that they're going to dishonor the notes receivable and not pay the notes receivable either. A note that is not paid when it's due is called a dishonored note. The balance of the notes receivable account should show only the total amount of notes that probably will be collected. The amount of the dishonored notes receivable should be removed from the notes receivable. The amount of the note plus the interest income earned on the note is still owed by the customer. Therefore, the total amount owed should be debited to accounts receivable in the general ledger. The amount owed should also be debited to the customer's account in the accounts receivable ledger. This information may be important if the customer requests credit in the future or if collection is achieved later. The interest income on a note has been earned as of the maturity date even though the note has not been paid. 3 Green does not write off the account when the note is dishonored. The company continues to try to collect the account. Later, 3 Green may decide that the account cannot be collected, and at that time, the balance of the account will be written off as an uncollectible account. Sounds a little confusing at this time, but again, remember, we're working on transactions that cover a couple of months. So let's go back and review. In this chapter, we have some customers that haven't paid on time. They want to take out a small loan, which is called like a promissory note. And so therefore, you are switching their accounts receivable or what they owe into a note or like a small loan. You give them a certain period of time to pay off that loan, 90 days, 120 days, whatever it may be, and then it is time to collect. Sometimes you collect that note, and so you will receive payment like we just had, and sometimes you will not collect that note. So once you cannot collect that note, then what you have to do is put the amounts back into their accounts to show that they still owe that amount. Hopefully that wasn't too confusing. Recording a dishonored note receivable. June 3rd, Stout Company dishonored note receivable for a 60-day 8% note, maturity value due today, principal of $3,000, interest of $40 for a total of $3,040. And this is all explained on Memorandum 98. So our accounts receivable is going to go up. by the total amount. Notes receivable is going to go down. We're going to cancel out the note of $3,000. Our interest income is going to go up by $40. In summary, the maturity value of $3,040 is debited to accounts receivable and to Stout Company in the accounts receivable ledger. One asset, a notes receivable, is replaced by another asset, accounts receivable. Recording a dishonored notes receivable looks like this. We will take the information from our T accounts and place it into our general journal.